Welcome back. We continue, move on with video 3 of the cost of redeemable debt. If the debt is redeemable, the cost of raising the bond is assessed by looking at the market value, post-tax interest, and redemption value cash flows. The easiest is to assess 1 unit of $100 debt. As alluded earlier, the bonds are given in nominals of 100. So tax has no effect on either the market value or the redemption value. But tax will have an effect on the interest. To compute the cost of redeemable debt, we use the internal rate of return approach. You will also meet the internal rate of return in investment appraisal. So the internal rate of return calculates the percentage return given by a project. It is helpful if the cash flows are laid out so that they look like a project as given in the example below. So you have your time there. You have time 0, then 1 to n. Time 0 will always be in brackets because time 0, which is multiplied by 1 in project investment appraisal, regardless of what discount factor used, you always multiply by 1. Then 1 to n, n will be the number of years given in the question. Then the interest, you compute the interest and then you strip off the tax from the interest. Then in the last year you have the redemption value. You will recall, if you've done investment appraisal, that the internal rate of return, or the IRR, requires that you prepare 2 NPVs. So equally, again, when computing the cost of redeemable debt, we need to compute, so we have to do this formula twice to get 2 NPVs. It's a 3-step approach. The first step is calculate the NPV of the project at, say, 5%. If, for example, the NPV is positive, we know that the project gives a greater than 5% return. Then we need the second rate to be higher than the first rate. That is assuming the first rate gives you a positive NPV. If the first rate you have used gives you a negative NPV, then you need a rate lower than that rate. So you move to step 2. So in this case, we're assuming that the 5% gave us a positive NPV. So step 2, we'll go for, say, 5 steps up and use 10%. So if, for example, the project is negative, we know that the project gives a return which is less than 10%. Once we have those 2 NPVs, Then we substitute in the internal rate of return formula. Again, pay attention, board mass again applies. Simplify the divisions, do the subtraction there before you divide. Do the subtraction of the A and B this side, then multiply. Before, the last thing you do is to add the A. Again, remember your board mass, extremely important. So in this question, we've got WPLC, which has $100,000, 5% redeemable bonds in issue. Interest is paid annually on 31st December. The ex-interest market value of a bond on 1st January 20x5 is $90, and the bonds are redeemable at a 10% premium on 31st December 20x9. Tax on profits is 30%. Required, what is the cost of debt? So here's 0. The value at the beginning of the bond, which will be in brackets. Then the bond is redeemable at 10% premium. Let's take a pause here. Pay attention to the redemption value of the bond. If the question says the bond is redeemable at a premium, so it will be 100 plus whatever premium is given in the question. In this case, the premium is 10%, so the redemption value will be 110%. $110 in the last year, as you can see there. If the question says the bond will be redeemable at a discount, so it will be 100 minus whatever discount that you are given. If we had a discount here instead of premium, then it would have been 100 minus 10, so we would have had 90 in year 5. Thirdly, the bond can be redeemed at par. The question says the bond is redeemed at par. Par is 100. So here you would have 100. So again, pay attention to what the instructions is giving you, whether it's at par, discount, or premium. Then, of course, your interest rate, you want to strip off the tax shield by subtracting the tax rate from 1. So you remain with 0.7. 0.7 times 5 will give you 3.5. Then, of course, your discount factors, which you get from the tables. The tables will be given in the exams. If you don't want to use the tables, you would still use the present value formula, but I will strongly urge you to use the tables so that you do not waste time with punching on the calculators to get the discount factors. So after discounting, we get our NPV at 10% as negative 8.48. Because it's negative, we go down lower than 10%, so we use 5%, we get a positive 11.39. We then substitute into the IRR formula to give us our cost of redeemable debt as 7.9%. If the examiner gives you a debt beta Then the cost of debt can be estimated using the CAPM. Another example there, if the market rate is expected to be 10% and the risk-free rate is 5% on debt which has a debt beta of 0.3, what is the cost of debt to the company if the tax rate is 30%? It's the same CAPM formula. What changes is simply your KD changes to RD there, or KD. Then you substitute your risk-free rate, your debt beta there, and you compute your premium there, and you get the cost of debt as 6.5. Now remember, debt pays interest, and interest benefits from the tax shield, so you subtract your tax there to give you the cost of debt as 4.5%. You may be given another form of debt, which is a convertible debt. The convertible debt is a debt which can be converted to equity at some future date at the option of the debt holder. Its cost in interest terms tends to be lower than straight debt, but at the date of redemption, the debt holders may convert their debt into shares. Not necessarily at the date of conversion, they can convert at any time of their choosing, but of course before the redemption date. The interest on the convertible debt tends to be lower because of that option of the holders to convert to equity. So this brings a bit of complication in its calculation, because the bondholders would only convert if the value of the shares is greater than the redemption value. So you need to establish whether conversion is expected to take place or conversion is not expected. There are implications of conversion taking place or not taking place in the way you actually compute the cost of convertible debt. So if conversion is expected, the conversion value is ignored and the bond is treated as redeemable debt. We compute the cost of convertible debt using the IRR method. But if conversion is expected, we still use the IRR method for calculating the cost of redeemable debt, but the number of years to redemption is replaced by the number of years to conversion, and the redemption value is replaced by the conversion value. Extremely important for you to remember those two principles. There is a formula for computing the conversion value. Please memorize this formula. Some exams they'll give you the formula, some exams you need to memorize it. So conversion value is equal to P1, open brackets 1 plus G, close brackets to the power N, then times R, where PO is the current ex-dividend ordinary share price, G is the expected annual growth of the ordinary share price, N is the number of years to conversion, R is the number of shares received on conversion. We look at an example. A company has issued 8% convertible bonds which are due to be redeemed in 5 years' time. They are currently quoted at $82 per $100 nominal. The bonds can be converted into 25 shares in 5 years' time. The share price is currently 3.50 and is expected to grow at the rate of 3% per annum. Assumed tax is 80%. You're required to calculate the cost of the convertible debt. Using the conversion formula, we compute the conversion value. Okay, so you simply replace in the conversion value your PO, which is your share price, okay, the current ex-dividend ordinary share price, your G, which is your growth, which is giving us 3% there, your N is your number of years, which is giving us 5, and R is the number of shares received on conversion, which is giving us 25. Since the conversion value is higher than the redemption value, so the conversion value will replace the redemption value in the last year. The rest will be the same as for redeemable debt. The market value at the beginning of the year discounted at 1%, at 1, sorry, not 1%, but 1, discount factor 1. The interest of 8%, the interest percent, 8% is given there. You take out your tax, which gives you 5.6. You multiply by the discount factor, then you get your NPV, which is positive. We said if the NPV is positive, then you want a rate which is higher than the rate which has given you the positive NPV. So we go higher, 12%. Do the same, get your negative, replace in the IRR formula, and you compute your cost of debt. We continue in the last video 4.